Hello everybody, I'm Dean Barber, founder and CEO of Barber Financial Group. January just about behind us as of the recording of this monthly economic update. Hope everybody's doing well so far this year. All right, some interesting developments. Obviously, it's no secret we have a new administration. There are going to be regulations put in place. There's going to be higher taxes. How's that going to impact the market? Where are we today? Should your investment strategy have changed since 2020? All the way into February here of 2021. So let's take a look at a couple of different things. I want to keep this short and sweet for you right now because there's so much that's unfolding from a political environment, regulation environment, tax environment, energy environment. We're going to keep a really close eye on things as they unfold throughout the course of the year. But a couple of things I want to point out to you. First thing is this. What we're looking at here are valuations of the stock market as measured by four different measuring techniques: the Crestmont PE, the cyclical PE10, the Q ratio, and the S&P 500 from its regression. So we're going back all the way to 1900, and you can see the peaks and the troughs, and these are either undervaluated or overevaluated stocks, measuring using an average of those four metrics. So a couple of time frames stand out here. 1929, where equities were 84% overvalued. By the time the 1929 crash hit back into the 1930s, we were 56% undervalued. Those of you that have been with Barber Financial Group for any period of time, you've seen these before, but I want to update you where we are today. First, before we get to where we are today, let's go here. 164% overvalued. That was the dot-com bubble. When that came crashing back down, we were still overvalued when we look at the average valuations over time. The 73% overvaluation, that was just before the Great Recession of 2008 into early 2009. But look at where we are today. The average of these four, as we measure valuations, have never been higher in the history of the market. We are sitting right now at 184% above fair value. So that in and of itself is enough to scare you. But we have to back up and say, all right, what are these valuations measuring? And are we in a different time today? And can these valuations be justified? Some people on Wall Street are saying the valuation can absolutely be justified because there's nowhere else to go. The 10-year Treasury, as we record this video, is sitting at just almost 1% exactly, which means that if you put your money into a 10-year Treasury, you're going to tie it up for 10 years with the promise of a 1% per year return, or a total return over 10 years of 10%. We all know inflation is going up at a faster rate than that, so that's a guaranteed loser for you. Some of the stocks out there, if you look at just the S&P 500 index, it's got a higher dividend yield, even at the current valuations, a higher dividend yield than the yield on the 10-year Treasury. So as long as interest rates stay low, these valuations can be sustained. So this isn't hit the panic button, pull the parachute and say, I'm out of here. This is just something that we're saying we have to watch this very, very closely. We have to understand what's happening, and there could be a triggering event sometime in the next 12, 18, 24 months that causes those valuations to come back down in the form of falling stock prices. Let's switch it up here just a little bit, and let's look at where is the performance in the markets so far this year. If you'll recall, in 2020, the technology stocks were the big winner. But if you go back and look at the last video that I did, I pointed out that the small and mid-cap stocks were starting to gain ground on technology stocks. And what's happening so far this year, as of the date of this recording, the S&P 600 small cap is up by 10.21% year to date, followed by the Russell 2000, followed by the mid cap up 5.32. Here's your NASDAQ, your QQQ up 4.73. At the very bottom of the pile, we see this, the Dow Jones Industrial Average up 1.18%, and of course the S&P 500 as of this recording up 2.65% year to date. So we have clearly seen the small and mid-cap sectors begin to dominate as far as performance. The question becomes, will that hold out for the balance of the year? Is this a short-term phenomenon that small cap stocks are doing better? One thing I can tell you for certain is if we go back over the last 5 years, small caps have lagged big time. So there's actually some room to run there. So you could just be seeing a shift in sentiment. You could be seeing a shift in where the big money is going, the institutional investors are going, and they're favoring and they're looking for better valuations, and there are better valuations in the small cap sector right now. So those small cap stocks that you have inside your portfolio that have maybe been in there for the last 2 or 3 or 4 or 5 years, now you know why they're there. Look, the seasons of investing change, and the sectors that are doing the best also change. It's always important for us as your financial advisors to step back, make sure that we're visiting with you about where your portfolio is today. Does it still fit within the confines of your overall financial plan? And making sure that we're never taking on any more risk than we absolutely have to in order for you to accomplish your long-term objectives. So until next month, we're going to keep a close eye on everything that's going on economically and politically. If something comes up where we feel like we need to share with you between times, we'll be sure and send out a special notice. Thanks for joining me for this monthly economic update. Everybody enjoy your day, and here's to a happy 2021. If you are joining us on social media, make sure and share this video with your friends, relatives, anybody that you know that might benefit from the information. Make sure and also subscribe and like our pages.